According to the Wall Street Journal, NVIDIA is negotiating up to $600 billion in financing for OpenAI, becoming the guarantor of its own largest customer. And it all centers on a former uranium enrichment plant in rural Ohio. This specific proposal, reported on July 26, 2026, outlines a $250 billion financial backstop. Under these terms, NVIDIA would act as a co-signor, allowing OpenAI to lease a 10-gigawatt data center campus in Piketon. The project developer is SB Energy, a SoftBank subsidiary which plans to construct a facility on the decommissioned Portsmouth gaseous diffusion site. Because Reuters could not immediately verify the report and the companies did not respond to requests for comment, the deal remains unconfirmed. Yet, the structural implications are clear. NVIDIA is negotiating to protect lenders against OpenAI's lack of an investment-grade credit rating, effectively guaranteeing the lease of the very customer driving the chipmaker's own historic stock market growth. Constructing a 10-gigawatt campus at Piketon is projected to cost at least $500 billion. Under the proposed terms, NVIDIA's lease and construction debt guarantee accounts for $250 billion of that physical build. On top of this, separate negotiations cover up to $350 billion to finance OpenAI's purchase of NVIDIA graphics cards. Together, these parallel agreements push NVIDIA's total contingent exposure to $600 billion, nearly half its total market valuation. This massive liability would sit alongside OpenAI's existing $1.4 trillion in infrastructure spending commitments. By financing both the physical footprint and the silicon inside, NVIDIA is effectively funding the very demand that keeps its stock price soaring. When a hardware manufacturer finances the very customer buying its products, it links its own financial health directly to the customer's commercial success. Under this arrangement, if OpenAI cannot generate enough consumer and enterprise revenue to meet its lease payments, NVIDIA is left exposed to the resulting shortfall. This setup is part of a broader, circular funding pattern across the technology sector. Chip makers provide the investment capital, startups buy the chips, and cloud providers build massive facilities based on those purchase contracts. The entire chain relies on the assumption of endless market demand. On July 24, 2026, Moody's Investor Service issued a warning that this capital-intensive model is already threatening the credit quality of industry giants like Amazon, Meta, and Alphabet. Credit analysts describe this concentration of risk as unprecedented in scale for the modern tech industry, creating a fragile loop where a single default could trigger a cascade of balance sheet write-downs. If market demand for generative models weakens, the financial pressure will roll outward in a straight line of exposure. NVIDIA's balance sheet sits at the point of origin, directly tied to OpenAI's ongoing ability to meet its obligations. Next in line, SoftBank and its subsidiary SB Energy carry the immediate development and construction liabilities on the Ohio site, where physical infrastructure must still be paid for. Downstream, cloud partners face severe destabilization. Oracle and CoreWeave depend heavily on OpenAI contracts remaining intact to justify their own massive capital commitments. Ultimately, this distress would trigger a wider sector spillover. A shortfall at OpenAI would instantly warp global chip demand forecasts, trigger credit rating downgrades for hyperscalers, and freeze data center investments across the entire tech industry. This creates a chain reaction where a single default threatens to pull down the balance sheets of suppliers, builders, and cloud providers alike. Because these negotiations remain uncompleted, the final terms of this massive arrangement can still shift. The entire construct rests on a single unproven assumption: that enterprise demand for generative models will yield the rapid cash flow required to cover these colossal liabilities. If software revenues fail to match the pace of hardware deployment, the financial pressure will quickly outstrip the capacity of even the strongest corporate balance sheets. This concentration of risk is drawing intense scrutiny from credit rating agencies and federal risk officers. Watchdogs are examining whether the scale of these interconnected liabilities poses a broader threat to financial market stability. The next 12 months will serve as the testing ground. If the Piketon project moves forward and successfully draws down its planned energy capacity, it may validate this capital-intensive model. If it falters under environmental, regulatory, or economic strain, this period will be remembered as the absolute peak of a speculative infrastructure bubble rather than the launch of a new computing era. Whether these reported talks solidify or fail, they reveal a stark reality. The AI boom relies on risky, circular funding. If this fragile foundation cracks, everyone pays the price.